All right. Good evening, everyone. Welcome again to our Tuesday night free webinar series. And I know there are some new people in here, so I'll go ahead and introduce myself. My name is Nate McGee, and I'm the Forex Live Trading Room Specialist here at Microquant. Let's see if I can get my slide to move here. So what we'll be talking about tonight will basically just be touching on the basics of technical analysis. We're not going to be going too in depth here. That'll take quite a long time, so I'll just give you some basics to help you get started, to kind of maybe get you familiar with some of the jargon in the industry, and better help yourself when you Google things, that sort of thing. If at any time throughout the webinar you have a question, just let me know and I'll do my best to just go ahead and answer it as I see them come. But obviously if there's going to be like an in-depth answer, I might put it toward the end of the webinar, so that way we can kind of speed along things here. But feel free to ask questions at any time. That'll be no problem at all. So before we go any further, we got to go over this risk disclaimer right quick. Basically, this just says trading or investing carries a high level of risk and it is not suitable for all persons. Before deciding to trade or invest, you should carefully consider your investment objectives, level of experience, and ability to tolerate risk. This content is subject to change at any time without notice and is provided for the sole purpose of education and assistance in making independent investment decisions. ValueCharts.com has taken reasonable measures to ensure the accuracy of the information contained herein. However, ValueCharts.com does not guarantee its accuracy and is not liable for any loss or damage which may result directly or indirectly from such content or from an inability to access such information, or any delay in or failure of the transmission or the receipt of any instruction or notification in connection therewith. Any past performance results are shown for illustration and example only, are hypothetical, and as such have many inherent limitations. No representation is being made that any account will or is likely to achieve profits or losses similar to those shown. Past performance is not necessarily indicative of future results. Doesn't really concern us again for this webinar because we're just kind of going over things, not really showing too many trades here. We also are required to put up this CFTC Rule 4.41. This is a U.S. government required disclaimer. Basically, all it is saying is that everything we mentioned in this presentation is, again, just hypothetical because it has happened in the past. And as you know, hindsight is always 20/20. And of course, as the saying goes, past performance is not necessarily indicative of future results. If you have any questions about these disclaimers or you want to look them over, feel free to go ahead and just contact us at support@microquant.com, and we'll be sure to send those things over to you. Right, so now that we got those formalities out of the way, we'll go ahead and get right into it. So this is the introduction to technical analysis. Well, these are the topics that we're going to try to cover here. Just basically what technical analysis is, some of the theory behind what technical analysis is, like how it started, things like that, some of the tools of the trade, charting basics, support and resistance, that sort of thing. At the end of the webinar, I'll try to send out these slides to everyone, so if I go too fast through some things, I'll send them in so that you can review them as well. We have not a lot of information to cover, but trying to speed through, I guess, the basics of it. So once again, like I said, if you have any questions at any time, just feel free to stop me. I'll try to elaborate on them a little bit more. So, what is technical analysis? We'll go ahead and get into it here. Basically, it is a method in which traders study price movement to help forecast future price direction. And these underlined words, I'll try to break these down a little bit more for you here. So the method, this can be a framework, which is all you use, like purely technical analysis, or it can just be a technique in your toolbox. People can combine fundamental analysis with technical analysis. Not a big deal. So you can do it either way. Price movement. This can be historical prices and current prices. A lot of times people look at the past to see what's going to happen for support and resistance, which we'll touch on in a little bit later on. And it's for forecast. This is not an absolute by any means. This is basically a prediction of what is likely to happen in the future. And it's worth noting that technical analysis is very subjective. Just because I see something on a chart doesn't mean that you're going to see the same thing on a chart and anyone else. There's a main difference between technical analysis and fundamental analysis. The way I guess I can describe it would be, if you're shopping in a mall, a fundamental analysis would be that guy that goes to each store, studies a product that was being sold, etc., and then decide whether to buy it or not. But then on the other hand, you have your technical analysis. That would be that guy that's just sitting on the bench in the mall, people watch the people go into stores, and they wouldn't really care about anything intrinsic about the product at all. They would basically only go to the store because they're basing it off the patterns and activity of people going into the store. If that makes sense, that's kind of how the difference is between there. So the theory behind this. Basically, history tends to repeat itself. There are really three concepts. A lot of them are based primarily off Dow theory that was established by Charles Dow here. But traders will repeat behaviors of traders that preceded them. If you got trained by someone, or you read a book, basically you're going to read their theories as well. Plus the psychology of greed and fear, they'll always be seen in the markets, because as long as there are human beings participating in the market, it's going to be there. Unless the market at some point gets totally mechanical, which I don't think it will be, you still will be concerned with the whole history repeating itself thing. Price moves in trends. This can be up, down, or sideways. Those are the three trends. Primarily it is just up and down, that sort of thing. And again, this is based primarily off of Dow theory, which is created by Charles Dow. And then we have another one, which is market action discounts everything. And price that you see in the market is basically a comprehensive reflection of all the market forces. What that means is economics, weather, etc., anything that can affect price is already being reflected in the prices. So at any given time, all the market information and forces are reflected in those prices. So it's even if technical analysis can't predict the future, it definitely does help in identifying trading opportunities. And things such as the history tends to repeat itself. If a price level is around a key support or resistance level that was from the past, traders will typically keep an eye out for it and base their trades around that historical price level. And a lot of these times, these price patterns and indicators that we're going to talk about that show signals, they tend to become a self-fulfilling prophecy. As more traders look for these certain price levels and chart patterns, the more likely that these patterns will manifest themselves in the market and actually be coming to fruition. So the tools of the trade. There are thousands, of tools for this, but we can kind of break them down. Charts. These are the main tool. These are the easiest way for technical analysts to visualize the historical price data. So you have your three basic type of charts here, which we'll kind of go over and discuss those briefly as well. You also have your indicators, and these are the categories of indicators. You have your trend indicators, momentum indicators, volatility, cycle indicators. Then you also have volume indicators. I'll throw those in here even though they're not really relevant for the Forex market, because volume isn't tracked in Forex like it is in, say, futures, because the Forex market is just too big. There's no centralized exchange that can actually keep track of that sort of thing. So now that we got those, we'll go ahead and touch on these chart types. First up is the line chart. Line chart is basically the representation is just a line that's drawn from one closing price to the next. Simple enough. And it doesn't really give a whole lot of information. I don't really see many people actually trade off a line chart. But it is good for identifying zones. I like using them to identify my support and resistance zones, because you can, if I could bring up my tool here, let me go ahead and I'll do a pen here. You can find your resistance right there, and this line could probably go across here, which become like an area of somewhat support. I like using them for this sort of thing. So that's why I enjoy using them. And next we'll go over to the bar chart here. This is typically called an open high low close chart, or OHLC chart, because they show the opening price, the high price, the low price, and the closing price of a particular time segment. That can be your daily chart, your 5-minute chart, whatever your time frame is that you're looking on. Each bar will reflect that time frame. Here's what it looks like. This is pulled from TradeStation here. So that's kind of how it looks. We also have the value charts indicator at the bottom to kind of show how that looks in correlation to it with overvalued and undervalued prices as well. And next we'll go to the candlestick chart, which is, this is pretty much the primary chart type in Forex. This is what I use primarily. I do use the other ones occasionally. It's definitely a great visualization tool, especially when it comes to the psychology of understanding the market and what goes on behind the trader itself. And a rule of thumb here is if price closed below the open, then the candle will be red, black, or filled. It varies. I mean, there's no real solid color that it can be. You see blue sometimes. It varies. And also, if price closed above the open, the candle will be green, white, or hollow. Those are kind of the most common colors that you see out there, but again, you can see many different colors out there. I like candlestick charts because they're really easy to visualize. The eyes adapt really like immediately to the information that's being displayed, and visually it helps with studying things. Like if you're trying to understand trading psychology or just understand trading in general, people can memorize visual concepts a lot better. So these are really good for that. And also reversal patterns and things of that nature. They also have really good names, really unique names for them, like one candle reversal patterns, that sort of thing. So it'll be easy to spot these trade opportunities. And they are broken up like this. We'll kind of break it down here. You can see if it closed above the open right in here, this is where it opened up right in there, then it's going to be a green, and then that wick to the upside here, that's the highest price that it reached, that's the lowest price that it reached in that time frame. And then on the flip side, same thing over here. It's the same sort of candle, but whenever it opens and then it closes way below it, then obviously it's going to be a red candle or whatever it is, blue, black, whatever. But the concept is still the same here. This is what it looks like here in TradeStation. You can see it's a nice visual representation. You can see there's a lot of green going up to kind of signify that uptrend. You can see obviously there's going to be a little bit of pullback every now and then, but this is really the most common in Forex. When you trade other things like futures and things of that nature, you'll see a lot more of the open, high, low, close chart. But for Forex, this is what I use, and a lot of people do use these as well. Are we good to go for that? We'll go ahead and continue on in with the next area. That's pretty basic. I think most of everyone should know that part. Okay. Support and resistance. This is pretty basic stuff as well. We'll go ahead and cover what it is. Some notes about it is one of the most widely used concepts in trading. Okay, we'll talk about different categories of this. It's two sides of the same coin, but we'll talk about that in a second. And what is it? We'll kind of give a elaborate definition here. So whenever the market moves up and then it has that pullback, the highest point that it reached before it pulled back, that's going to be your resistance level now. And then on the flip side, when the market moves down, then it starts to head back up a little bit. The lowest point that it reached before it moved up is now the area of support. These are the concepts here that support and resistance, they are not exact numbers. I run into this a lot. People think that if it priced at 1.4385, that when prices touch it, that it's going to be respected. It does occasionally, but not all the time. These levels really are just the slowdown spots of the charts where price tend to test the levels. They can go really deep into it. They may not even reach it. The way I like to think of them are zones, beer bellies, hot spots, that sort of thing. I like the beer belly analogy a lot because it kind of sticks out in my mind a little bit more. It's squishy. You know, you can push into it. At some point, though, you might meet resistance. Another thing to note here is that when support is broken, it becomes resistance. When resistance is broken, it becomes support. I have a little typo here. Disregard that. When support is broken, it becomes resistance. And then resistance is broken, it becomes support. Here's that concept that we're talking about. When it makes a new high, and it pulls back, that's when it becomes resistance. And then when it falls down, it starts to head on up, that's your support. Has this little zigzag pattern here. Here's a little picture of a range here. This is the most simplest way I can show it, I suppose, when it's just moving sideways. You can also do it with other charts, but you can see this whole area right down in here. This is all support every time prices bounce. But as you can see, even though it really went into the zone deep down here, you can see it still pulled back up inside of that area. It's just testing it. These areas are meant to be tested, really, to see if they really hold historically. Same thing over here. And you can see it went through the zone, then finally it did break out here, but you see it did try to come back in a couple times, especially with this one right here. So that's basically the easiest description of what these are. We'll go ahead and show more here. Trend lines. Now this is the most common form of the technical analysis. This is that second part of the coin that we're talking about. Support and resistance is the biggest concept, but trend lines are probably the most common form, the most used form of technical analysis here. And it's really used to determine whether or not a given trend or a lack of trend will continue at all. It just kind of helps to bring things in a consolidation area so you can focus on one thing at a time. Uptrend lines are drawn along the lows of support areas, also known as, you'll hear valleys occasionally, or that's basically it. You'll hear lows and valleys. Downtrend lines are drawn along the highs of resistance areas. These are known as the peaks. And show you how this looks here. Did this one today, actually. This is on the Aussie Kiwi dollar cross on the 240-minute chart. It's pretty interesting to see here. But you can see here's a descending trend line. This is across the peaks, the highs of it. And you can see that it's making lower highs, which is kind of the definition of a downtrend. If it's lower highs and lower lows, that's typically a downtrend. And then if it's an uptrend, it is higher highs and higher lows. So as you can see right in this area, somewhat, you can see here's a low, and then here's a higher high, here's a higher low, that sort of thing. But this is also, looks like actually a head and shoulders pattern, which we'll talk about a little bit later on. But this support, this is where prices are bouncing off. These are your buy areas right in here when it bounces, and then these are your sell areas right in here. And also here's a double bottom, which is nice to see as well, which we'll talk about again a little later on in the webinar here. So that's really the intro for trend lines. All you really need is at least two tops or two bottoms to draw a valid trend line, but it takes a third to confirm it's a trend line, so a third touch. And the steeper the trend line you draw, the less reliable it's going to be, and the more likely it'll be to break. And you don't really ever want to force a trend line to fit, because that could end up, if it doesn't fit right, then the trend line isn't valid. But that's really the key concept you want to remember about this. I'll save that for some more in-depth webinars in the future of how to like fine-tune and make better trend lines and all that sort of good jazz. Channels, that's another branch of this whole support and resistance thing. These are used to determine good places to buy or to sell. You can buy the bottom, sell the tops. In an uptrend, you draw a parallel line that touches the peaks. Most charting platforms have the option to draw a parallel, so it won't be hard to try to eyeball it yourself and see, oh, is that perfectly parallel or not. It'll just be right click. Sometimes like draw a parallel, draw an exact same angle of the line. You can plop it on there. On a downtrend, you draw parallel lines that touch the valleys. And there are really three types of channels here. You have your ascending channel, which is the higher highs and higher lows. Descending channel, your lower highs and lower lows. And of course, you have your horizontal channel, which is just a ranging market that is moving sideways. These are really good for range traders. There's a lot going on here. I kind of break it down for you here. But based on the concept of support becomes resistance whenever it's broken, can be seen really nice here. So we have our first horizontal channel right in here. This is our first horizontal channel. You can see here's our support where price is bouncing off of, right up in here, as well as resistance. All good. But then when price does break to the downside, this area now becomes resistance, as you can see right in here. And when it comes down to a new horizontal channel, which is down in this area, or better yet, we can just say this is our new horizontal channel here. We have our new support, and then here's our resistance as well, which price is respecting as well. This is a common occurrence out there when you look at the markets, that if it's a valid level of support or resistance, once it's broken, prices tend to retest again. So we have, here's our two horizontal channels back to back, and then right here we have a nice ascending channel here. So I drew that along those lows, and then I drew a parallel, and I put it up here, and you can see it's not exactly perfect. Not a lot of times out there in the market, things aren't perfect in textbook, but the theory is still there because prices don't really stay above here. They may test it out a little bit, and that kind of depends on each market. They'll shoot through it a few times like it does in here, but for the most part, like right here, this is really kind of fake out. You see it, prices really pulled back in quickly after they went ahead and broke through here. Let me just go ahead and erase all the link side. There we go. So once it did break to the upside here, you can see the next candle just shot back down inside there, so it's just fake out. So those are channels. I didn't bring a descending channel here, but what you want to do is really good for range traders. You can, buy down here, sell up here. Once you see the channel is, you know where to go. It's really especially good for those range traders because they don't really care about direction. It's just they want to make money, so they can go up and down all day long until it breaks out. Once they break out, they know they're wrong. Then they're going to wait. It might not be the best for trend traders because they don't have the patience, or they'll have the whatever you want to call it, to get in and out of trades that quick. They want to catch a bigger move. A couple of key notes here is that whenever you construct a channel, for the ascending or descending, you want the trend lines, they must be parallel to each other. Again, you don't want to ever force the price in the channel that you draw. If their angles are off, it could be a different sort of pattern and not a channel itself. So you need to be careful of that. And those are basically the three areas of that whole concept of support and resistance that is the major part of any technical analysis. Now we'll talk a little bit about indicators before we go on. Are we all good on that, or do we have any questions? If not, we'll go over this and we'll really glaze over these because we can spend hours and hours on technical analysis. Indicators, there's thousands of them, but I'll show you some of the more common ones anyway and how they are in different categories. Okay, cool beans. Let's go ahead and get down in here. Some notes first. Indicators mostly look at the same thing, which is price. I say mostly because there are some indicators that don't always look at price. You can't just say with 100% fact that it's true that it doesn't look at price all the time, but I would say 99% of the time they all look at price, so keep that in mind. There is no holy grail indicator. A lot of people spend a lifetime searching for this indicator to make sure they find the best one. They'll never work, they'll never happen. No indicator will work in every market. It's all about choosing your tool for the right time. Just because a trend indicator works in a trending market, it'll probably be destroyed in a ranging market. So you need to know when to use your tools and how to use them properly. Really, there are two types of indicators here. You have your leading, which will give you a signal before a new trend or reversal occurs here. You also have your lagging, which gives a signal after the trend has started. And it just basically, slaps you in the face, say, hey, you might be missing out on this. Check it out. Get on in on this trend here. Those are the broad categories, and we'll kind of break these down into some more smaller categories here. So we have our trend indicators, like we were saying, we kind of discussed a little earlier on. These indicators, they really help define or visualize the direction or trends of price, and it just smooths them prices over a defined period. It could be different look-back periods, that sort of thing. Some examples are moving averages, the ADX, Ichimoku, that sort of thing. We'll show some pictures of that. We'll touch on just briefly, but won't go too in depth on that. You have your momentum indicators. These just show the strength of the trends, visualize it like the speed or how fast prices are moving up or down over that defined period of time, whether it be daily chart looking back 30 days, 12 days, whatever. There's a few that are common out there: RSI, MACD, stochastics, things of that nature. You also have your volatility indicators, and these show the size and magnitude of the price fluctuations. So these are really good during times, say, news announcements. They might be helpful so you can see how much prices moves out of their normal range. So you have your average true range, the ATR indicator. Bollinger Bands are also used quite often out there. Then you have your cycle indicators. You don't really hear this term used too much, I guess, but it really helps you find the cycles or the repeated patterns of a market. Most common ones here would be Fibonacci retracements or extensions, and then Elliott waves. And Elliott waves, that you can find hundreds of books on that. Same with Fibonacci. So again, we'll touch on these kind of briefly here. First off, we'll go ahead with trend indicators here. I have three of them on this one. We have an EMA, which is your exponential moving average. That's your white line. Okay, this line right in here, that white line, that's your EMA. Then you have your pink one, which is your SMA. This is your simple moving average. And again, as you can see, they are just two different types of moving averages. Still, they're both using price as the underlying fact or information to determine what they are. It's just they manipulate it in a different way to make it a little bit more visually appealing. It all depends on how you want to use the actual indicator itself. And you also have the ADX down here. Okay, and this is your average directional index. Basically, this kind of tells you how strong or how weak the trend is. It ranges between 0 and 100 for the most part. Anything below 20 is a weak trend. So right down here, you can see this is right below that 20 mark, and it means it's kind of becoming a weaker trend. And then anything above 50, sometimes it becomes like a strong trend. Again, that kind of varies depending on who you are, the time frame, that sort of thing. As you can see, it gets kind of weaker down in here before it actually starts to rally up from like this area right here. If you look up, you can see it started to head on up. You can kind of get in on it a little bit early. Then right up here, right around the 50 mark, right here, you can see it's kind of a stronger trend before it starts to roll over a little bit. So those are your trend indicators. This one, I know it looks confusing. This is the Ichimoku. We could spend hours on this. It looks confusing, but it can be really useful as well. Basically, it's an all-in-one type of indicator here. It gauges future price momentum and determines future areas of support and resistance, like on the fly. This is primarily used on the yen pairs. Okay, and basically it's used and uses a couple of key numbers, 26 and 52, I believe it is. The reason why 26 is important, it's really good for weekly charts, daily charts, and hourly charts. So for daily chart, there are 26 working days in a month, so it gives you a good reputation looking in the future and the past. So it gives you a full spectrum on that. Half a year is 26 weeks, so that's good for your weekly chart. You can kind of get a visualization of that as well. And then on an hourly chart, it'll give you a little bit over a day's worth of data with 26. So that it's really good for those type of time frames and really good for the yen pairs, because anyone who trades the yen pairs or is over in Japan that doesn't, they all use these type of indicators. So if you see the same picture they see, you're in good hands for the most part. So these indicators will just help define those prevailing directions of trends and price moves, and they just really help you visualize it a little bit better. Nah, I kind of did, Jim. The question here was if I become an Ichi fan. I did for a little bit. I do like to look at it sometimes, occasionally, on my weeklies and dailies. As a quick glance, if I see a cloud like right over here, this looks a little bit more bullish to me. In the future, I'm ready to use it in that sense, but I don't necessarily use it as trying to get on it when it bounces on the support and resistance levels. But it does do a pretty good job from what I understand and what I've seen. Next, we got our momentum indicators. We'll just cover these briefly here. So this one, first of all, is RSI. This is your relative strength index. It really identifies overbought or oversold areas of prices. And again, this kind of ranges between 0 and 100 as well. Anything below 20 is oversold as a rule of thumb usually. Anything above 80 is overbought. And it can really be used, it can sometimes be used, I should say, to determine trend. If you look at anything above or below 50, so if it's above 50, like right in here, you can see this might be considered an uptrend. Anything below 50 would be considered a downtrend. And whenever you're in the overbought or oversold, so right up in here, anything above, that is overbought area. You can be looking to kind of sell this area. That's RSI. Then you also have MACD. This is really common out there. This is moving average convergence divergence. This just basically takes two moving averages, a fast one and a slow one, different time periods, say like 26-day and a 12-day. One's going to be faster than that. And the little histogram lines on here, these are really to show the separation between the two moving averages right in here. So it's relative to that. So you can see like how fast a market's moving up here based off previous data. And you can also use it to find divergences in prices, which we talk about in a later webinar. Not really touch on them too much here, but you can find areas where price can change again on some really good entry points here. Then we also have stochastics. I don't use these too much here. Again, these are kind of like overbought, oversold. Again, these range between 0 and 100 for the most part. Anything below, say, 30 is considered oversold. And anything above 70 is considered overbought. Kind of split these things up here. This is how TradeStation does it. Shows a stochastic slow, and you have your stochastic fast here. You can see one's a little bit smoother than the other. Not sharp spikes with a slow, but then on the fast, you can see a lot more sharper peaks, that sort of thing. So you can kind of find some of your selling points, like right in here. That could have been a nice selling point right in that area. Again, this whole area in here is kind of indicating it's time to start selling things because it's getting overbought, which is relative to this area. So they can be good for that. Next, we'll talk about volatility indicators. I have the two main ones here, your Bollinger Bands and your ATR, or your average true range. Your Bollinger Bands is based off the concept of price tends to return to the middle of the bands. Prices will go up somewhere, rally up, but they'll also pull back usually to their equilibrium area. That's what this is kind of based off of. So you can see prices are right here in the middle. Then they do start to head on up higher. They'll really start extending and go up to this upper band. And then once they start coming down to the middle part, you can see it actually brought all the way down to the bottom band. There are many different strategies for this. Bollinger Bounce, which we can talk about in later webinars if that interests people. But the concept really is to sell on a touch up here and to buy down in here when it touches the medium one, the lower one, but then when prices are kind of in the middle that don't really do much to it. These kind of show, again, the volatility of the market, how fast it's reacting, like if it's going in and out of its certain range or normal ranges. Then you have your average trade range down here, and really if there is a higher level of volatility, you'll have a higher ATR. So if you look like right down in here, you can see it's kind of low. There's maybe a little sticking point where it's kind of neutral. Then when it does start shooting up, you can get a little more volatility, and then down here when it's lower, you can see it's kind of just hitting rock bottom here, going up a little bit, and that's how ATR is used for the most part. So you can use that to see how good a market's moving. This will be a totally different picture in a ranging or sideways market. You'll see ATR just stay kind of flat all the way along the whole area. And then next we'll go to some cycle indicators. I didn't do anything about Elliott waves because that's a whole different ball game to kind of tackle there. But Fibonacci, these are numbers or ratios that are really significant, that they occur often in nature and also in the financial markets. On any really financial market it could be used, but it is used quite often out here in the Forex market. I use it occasionally, don't use it a lot, but I do know a lot of people do use it, and I use it in my toolkit basically because the whole self-fulfilling prophecy thing, if a lot of people are using it, I might just look at it so I can know what they might be seeing. Helps me out for that. Basically the concept for this, or how to draw these Fibonacci, is you want to draw it from left to right. So if there's a bullish or a trend you're noticing, then any retracement to the downside, like that hits one of these little levels here, that would be where you kind of want to get in on. Some of the most commonly used Fibonacci levels are this 38.20, 50%, and then 61.80. These are the key points that a lot of people do use, and you can see from the swing low to swing high, that's kind of how you try to identify it. You can see price is really well respected at the 38.20. You can see it did have a little bit of pullback right in this area. Then when it did break through it, it came right back down to that area before it kind of slowed down a little bit. Then it dropped again down this next level, and then when it did start to rally back up, hit that level again. That's another key area, and you can see how it just moves on up. It could be used for identifying those support and resistance levels. It can also be good for entry exit points depending on trades. If you got in down here, you see it's a bullish trend. If we had our swing high up here at one point, we could see price probably retrace down this level, get in on it, and then maybe you can say my first profit target is right here, second target will be right in here. There's many different ways you can use it. So well, that's what we just do, is touch on that one. Elliott waves, again, you can Google that. It's something worth knowing. It's all about how price moving waves. Are we good so far? Give me a yay or a nay. Want me to slow down? No problem. If not, we'll segue into some of these chart patterns here. All right, excellent, excellent. Chart patterns. These are, well, repeat patterns that happen in the market all the time. Is what that concept is, a whole technical analysis thing about history repeats itself. Humans repeat themselves, and there's not much really we could do about it except take advantage of it if you know what to look for. Some notes about this. The chart patterns are just a representation of trader psychology or sentiments, how they feel about the market, or people trying to jump on the bandwagon and things of that nature. Chart patterns are really classified in two ways. I put this in here so that way you can know, again, maybe some ways to Google it, but they're the reversal patterns or continuation patterns, or bullish patterns and bearish patterns. They're both the same coin, just two different sides. You'll hear them defined differently, but that's what you want to look for if you're trying to Google something. I want to look for reversal patterns, reversal chart patterns, or continuation chart patterns. You can do that, or you can say bullish chart patterns or bearish chart patterns, that sort of thing. So let's throw that in there so you can help yourself out with that if you want to look into it further. And it's also worth noting that the longer the time frame that pattern forms on, the larger the move. Okay, so you may see one of these nice chart patterns from like a 5-minute chart, but it might not move as much as it would on a daily chart. That's another note about these chart patterns here. So I'm gonna show you some of the higher probability ones. I'm not going to show you all of them because there's countless patterns you can do. Plus, you can always look at candlestick reversal, which is a totally different area as well. So I'll show you some of the more common ones that are higher probability that are typically reversal for the most part. So you can maybe find the absolute bottoms of the market or the absolute tops of the market, that sort of thing. And it's also worth noting that these aren't always going to be textbook. You could try to find some textbook ones, but it doesn't always happen that way. So first of all, double tops and bottoms. Double tops, these form during an uptrend, and double bottoms, they form during a downtrend. And you want to enter in on the trade once price breaks the neckline, which I'll show a couple pictures of that. But here are some of the characteristics of them. So you have, for tops, you have a rally to a new high, which will be your first top. Then you have your little bit of pullback. That low, when it starts to start heading back up again, that's where your neckline is going to be. Then you'll have another rally to right around the same level. Sometimes it's right at the same level, a pip off. It could be a little above, it could be a little below. But that's your second top. And then it starts to pull back, and when it breaks the neckline is when you want to enter in. It's confirmed double top, and it does look like a little bit like an M. That's the way I like to kind of visualize it. Then bottom is just basically the reverse. You have a first fall to a new low, then you have a little bit of pullback. It'll start head higher, then it'll come back down that that area again, about the same low. Again, might go a little deeper in. All this depends. And then when it breaks back to the neckline, that'll be a double bottom, and that looks like a W for the most part. Here's an example. It's a double top on, I believe this was the dollar Swissy on a 240-minute chart. But as you can see, we're saying here's that first high. Okay, then gonna have a little bit of pullback here, and then wherever it found support, it doesn't have to be this area. It's just that's where it landed. It could be many different areas, but then when it starts pulling back up, that's where your neckline is going to be. It'll come back up to right around the same area. Okay, that's your second top, and then comes back down. Once it breaks through that neckline, you could have a confirmed sort of reversal pattern here for double top. You enter in short right there. Put a stop right above this area at some point. You can see it just continues to head on down there. Looks like we almost had a double top over in this area again as well. Neckline break right in here. Yeah. So there's that. And then we'll look at the double bottom now. Just the inverse of it. Same concept. When we're in a downtrend here, continues to head on down. Here's that first low, and then comes back up, makes the neckline area, then comes back down right around the same area. You can see right in there, that's where your lows are, and then of course it comes back up and it breaks through. And you can see it does come back down that area, so it was a little bit iffy, but it still does continue to head on up. And this was on the Aussie dollar here on the daily chart. So I mean, these moves are really big. For the most part, these kind of have a measured move, meaning that whatever the length is of this area from like right here to right in here, you can basically say it might move that same direction this way. Doesn't always happen that way, so you might want to get out a little bit earlier than usual. That's kind of the rule of thumb that I follow. That's the measured move aspect of it. You can also use like a momentum indicator along with watching the breakout, so you can kind of see if it's going to continue head on up or might be slowing down to help you get out. Next, we'll look at the head and shoulders. This is a really common one. These are really good. They really do move a lot whenever they do actually form and actually follow through here. So head and shoulders, these form during the uptrend. There's also another one which is the inverse head and shoulders. These form during the downtrend. I just went ahead and classified them both here in this slide as head and shoulders. This is the same thing. You enter a trade once price breaks the neckline. And then we'll have some characteristics here. It's not as easy, I guess, to define the characteristics of it without it showing you visually. But here are the rules to look out for. There's your rally to a high, which will form your left shoulder because it'll have a little bit of pullback, and that'll be the first tip of a neckline. Then you'll rally to a new high, so it'd be higher than that first high that just made, and then it'll start having a pullback, which forms that head. And then whenever it starts to bounce off that new low, which would be our neckline, it'll rally to another high, which would be the right shoulder, because that high will be lower than the head's high. Then it'll pull back. Then once it breaks the neckline, it moves in that direction to the downside, and the measured move aspect still applies here. Again, inverse head and shoulder is just reverse of that. I think it'd be better for you just to kind of see it visually as opposed to me trying to describe it. And again, I'll send these out to your email so you can maybe word them a different way for you and maybe get an understanding that way. So it doesn't look like an exact textbook head and shoulders here. Again, it doesn't always happen in the market, but here is our first high. So imagine a shoulder right here. Okay. Then it comes back down. Here's that first tip. We haven't really had a neckline yet. That's what we're going to be looking for. Then it makes our new high up here. This is where our head is. Comes back down to, doesn't have to be this level. Sometimes it'll be right here. Sometimes it'll be up higher. Sometimes it might be lower. Sometimes you can have your neckline be at an angle too. Just all depends. And then once it starts heading back up, here's our right shoulder that formed as well. This high is lower than our head. That's what we're talking about. It has to be lower than that. So we're waiting for price to break through the neckline. And you don't want to get in on it right away. I like to see it kind of verify itself. And you can see right here, this is actually during a news announcement, so you had a little fake out. It pulled back up a little bit, but then as you can see, once it actually broke through there, it fell down pretty rapidly here, and the measured move concept applies here as well. So you have that high roughly to about right here of the measured move. So if you look at it from here, you can see we had to move all the way down to right here, roughly the same amount. So you can know how to kind of get in and out of these patterns when they actually do happen. And you can see when price did continue to head on up, it actually came up here to retest that neckline again. That whole concept of support and resistance comes back time and time again. So the support is now resistance. You can see it served as resistance right in that area. That's the head and shoulders. We'll go ahead and look at the inverse head and shoulders. This looks a little bit better. It's pretty tight. And it doesn't have that wide spread like the other one. I think this is the Aussie Loonie cross on a daily chart here. But as you can see, the same concept here. You have your first low. Then you have that new low, which is much lower than this low. And then you have that next low, which is higher than that previous low. And that's your head and shoulders. And then that neckline, once it broke, you can see it just shot on up to the upside here. And the measure move concept still applies, but as you can see, it continued to head on up way past that. You can also vary on how you trade. You might have 2 or 3 profit targets. You can have your first one to be that measured move, put a break-even stop in, whatever, and then see if it'll continue to head on up higher. That's just however you want to trade it, how you manage your stops, which that's my next webinar, I think, actually, all about managing stops and profit targets and that sort of thing. So we can kind of touch on these again to show different strategies in managing trades. The next one is going to be wedges. These happen a lot. I actually love wedges probably the most because they happen so often. You have your rising wedges, and these are always bearish, but if they're in an uptrend, they're considered a reversal pattern. So you see a nice move to the upside, be looking to short it near the top. And if they're in a downtrend, then it's typically a continuation pattern. So you can still get on a trade that you might have missed earlier on for a downtrend or whatever. Then you have your falling wedges. Seems a little counterintuitive how these are, but falling wedges are bullish. In an uptrend, these are considered a continuation pattern. And in a downtrend, these are considered a reversal pattern. So just the flip side of what a rising wedge is. The characteristics of these are price will consolidate on a rising wedge between upper sloping support and resistance lines. It's not a channel exactly. It looks similar to a channel, but there will be some tweaks to it. The support line is much steeper or slightly steeper than the resistance line at the top. And the kind of psychology behind this is that the higher lows of what we consider an uptrend, they're made faster than the higher highs. So that means, yeah, sure, they're making higher lows, no problem, but the bears are doing a pretty good job not making too many new highs. So they're really still a lot stronger than the bulls are. Then on the flip side as well, for the falling wedge, price consolidates between the downward sloping support and resistance line. The resistance line is steeper than the support line, so the bears are trying to push it down, but the bulls, they're not having it really. The bulls are keeping the bears pretty well in place until they decide to actually break to the upside. And go ahead and show you some examples of that. So as you can see, this is kind of touched on both of them in a sense, depending on how you look at the chart. But if we're looking at this being a downtrend here, okay, then this is a rising wedge that's forming in a downtrend. So it's considered a continuation pattern. So as you can see, it went on up. Then once it actually broke through, it shot back down. But say if we went ahead and crossed off all of this out and we didn't consider that a downtrend, then all we're looking at is this right here. That's considered an uptrend. Okay, here we are in an uptrend. Then it's still considered a reversal pattern in the uptrend, because once it hits near the top, it kind of pitches out and then breaks to the downside. So just know that they're always bearish. Just know which kind of direction of the market you're in. So I would better prepare yourself for certain things, I suppose. These are fun to trade. I love trading these a lot. As you can see, again, these aren't going to be textbook. You'll see these go deep into the support and resistance zones, but the theory you want to follow is that it doesn't really close below or above a certain area. It may test it, but it usually pulls back pretty quickly, like it does right in here. It broke through, but it still shot back up inside that area as well. And again, it's not that channel that we have where it's not perfectly parallel. Okay, it's slightly different. It's just making these highs. These are slightly slower, and you can see this line is a little bit steeper than this one. If you put these two lines together, you'll see this line come across it somewhat like this. Okay, that's a rising wedge, and then you have your falling wedge. This kind of can describe both sides of it as well, depending on how you want to look at it. Say the falling wedge, this is all considered a downtrend from right here, say all the way down here, however you want to call it. But you can see this resistance line right here. You just go ahead and remove that for a second. This line is much steeper than this one. This is a lot more angled, I suppose you can call it. And that's just really a bullish sign, and it, as you can see, breaks to the upside here. If you disregard all this stuff back here, get rid of all this, don't look at it, and well, from right here I should say, consider this to be that uptrend right here, then when you see it forming an uptrend, it's considered a continuation pattern. So it's just that cool down period. Everyone's like, okay, we just bought a lot. I don't know if I want to buy it at that price. That's way too expensive for me. Usually it's selling off, people taking profit, so it pulls down a little bit. People are like, I don't want to really continue it to be that low, but people are still greedy. Like, I want to buy it cheaper. I want to buy it cheaper, and then finally it overwhelms them to the point where all the bulls just like, okay, it's back down almost to where we started at. Let's go ahead and continue on up. That's that. So that's it. That was the down and dirty, really quick version of it. Some of these things we'll talk about a lot later. In a few weeks, I have some that are specialized. I actually do have a webinar, I believe, over Ichimoku itself. I have other ones just over certain key reversal patterns, candlestick reversals, and also have one that I'm going to do about making these reversal patterns be higher probability trades. You can look for some key characteristics to help you out a little bit. So that'll be in the future. But are there any questions anyone has? Hope I didn't go too fast. Hope everyone understands everything. If not, I mean, I don't mind calling it quits a little early, get you out like 3 minutes early. but I will send these slides out to you, so that way you'll have your notes and you can refer back to them again. And feel free, like I said, to Google some of these things. That's what kind of put them in there. This is just that brief introduction course. It's not going to cover everything. I kind of say that for later webinars, and when I get people that are really interested in it, they may want certain things, and I'm more than happy to make webinars specifically for that, to kind of explain it. This is just to get your feet wet, see if you like it, and help you understand it a little bit better. So, we all good? No, Kevin. These actually start at 8 Eastern Standard Time, but I am recording it, so I will put it on up there, get it uploaded there for YouTube for you. Yeah, no problem. And you're welcome, Jim. All right, Rob. Cool. Okay. Well, if there's no questions, then again, I'll send these notes out to you probably either tonight or maybe tomorrow. Send them all out to you. And if you have any questions even during that time, just let me know. Or if you have any topics you want maybe discussed further, let me know as well, and I'll try to see about making a webinar for that. Okay. Well, then this should be up next couple of days, the webinar itself. So yeah, just keep a lookout for that. And we're all good then. Y'all have a good night. We'll call it quits a minute early here. And I look forward to seeing you all in the trading room and other events. All right, have a good night.